The rule behind every oil crisis. Finverse Stories, script 0 o'clock. This is the kind of crisis that governments always describe as sudden, temporary, and unfortunate. A disruption here, a war there, a tanker route under pressure. A few missing barrels, then prices jump. Inflation spreads, central banks panic. Consumers get squeezed, and the entire economy starts behaving like it just discovered gravity. But oil crises are not random acts of economic weather. They follow a rule. The names change. The flags change. The headlines change. The rule does not. When a modern economy loses confidence in the flow of its most important input, the damage moves outward with ruthless speed. Not because oil is magical, because it sits underneath almost everything else. Welcome to Finverse Stories, where money, power, and history collide. And nothing is ever as simple as it looks if you want to understand why one disruption in oil can rattle inflation. Interest rates, politics, and financial markets all at once. Start with this. Oil is not just another commodity. It is a base layer. It powers transportation, shipping, aviation, construction, mechanized agriculture, petrochemicals, plastics, and much of the physical movement that makes a modern economy feel normal. That is why oil shocks do not stay in the energy sector. They spread into food, freight, industrial costs, household budgets, inflation expectations, and eventually policy itself. IMF research on inflation shocks since the 1970s found that more than 60 such episodes were linked to the oil crises of 1973 to 1979, and that even successful disinflation after major shocks often took years. The first disruption is physical. The real damage is systemic. That vulnerability was built long before the first famous embargo. During the 20th century, industrial society reorganized itself around abundant petroleum. Cars replaced horses. Highways expanded. Suburbs spread outward. Aviation compressed distance. Tractors and fertilizers transformed agriculture. Container shipping shrank the world. Military strategy adapted to mobile, fuel-intensive logistics. Oil did not just support growth. It became part of the design logic of growth. By the post-war decades, especially from the late 1940s through the 1960s, the developed world treated cheap and reliable oil less like a strategic variable and more like a permanent feature of life. That was the real setup. The future was being built on the assumption that energy density, affordability, and availability would keep scaling together. And assumptions like that are wonderfully profitable, right until history decides to invoice them. By the late 1960s and early 1970s, the system was already more fragile than it looked. Us oil production, which had once anchored the global market, was no longer the unlimited stabilizer it had been earlier in the century. Domestic production peaked around 1970. Dependence on imported oil was rising. Meanwhile, more of the world's marginal supply was shifting increasingly toward the Persian Gulf and the politics surrounding it. OPEC, founded in 1960, was no longer just a loose producer grouping. It was gradually becoming a force capable of shaping the terms of the market. In other words, the world economy had become more dependent on a globally traded strategic input whose flow was concentrated in politically sensitive regions. That is not a minor detail in economic history. That is the mechanism. Then came 1973. In October of that year, war broke out when Egypt and Syria attacked Israel during Yom Kippur. Arab OPEC members responded to Western support for Israel with production cuts and an embargo targeting the United States and several other countries. The result was not just a rise in energy prices. It was a repricing of the industrial world's basic assumptions. The nominal price of crude roughly quadrupled, moving from around $3 per barrel before the crisis to nearly $12 by early 1974. Fuel shortages, long lines at gas stations, rationing measures, lower speed limits, recessionary pressure, and accelerating inflation followed across much of the advanced world. In the United States, CPI inflation climbed into double digits by 1974, while growth weakened and confidence deteriorated. What mattered was not merely that oil had become expensive. It was that one of the most important prices in the world had moved in a way that forced nearly every other sector to renegotiate with reality. Transport costs rose. Manufacturers paid more for inputs and distribution. Farmers faced higher fuel and fertilizer costs. Airlines suffered. Freight became more expensive. Households saw more of their income diverted toward energy and transportation, leaving less for everything else. Governments were caught between slowing growth and rising prices. Central banks faced an ugly choice: tolerate inflation or tighten into weakness. That was when the phrase stagflation stopped sounding theoretical and started sounding like a diagnosis. The old macroeconomic assumptions of the post-war era looked suddenly inadequate, because they had been built for a world where supply shocks of this magnitude were not supposed to dominate the story. History disagreed. But the real lesson of 1973 was not the embargo itself. It was the structure the embargo exposed. The modern economy had become so dependent on abundant petroleum that even a partial disruption could send political and financial consequences cascading through the system. The shortage was the spark. The design of the economy was the fuel. That is the rule behind every oil crisis. The damage depends less on the headline trigger than on the degree of dependence already baked into the system. A society that builds itself around cheap energy does not need to run out of oil to suffer. It only needs to lose confidence that supply will remain stable at an acceptable price. Then, just a few years later, the world got the same lesson again, with different actors and the same ending. In 1979, the Iranian Revolution disrupted production in one of the world's major oil exporters. Iranian output fell sharply. Market fears intensified. Buyers scrambled. Hoarding and panic buying amplified the effect. The second oil shock drove prices sharply higher again, contributing to renewed inflation and another round of economic strain across oil importing economies. The trigger was different from 1973. There was no identical embargo, but the mechanism was the same. The market did not need the exact same crisis. It only needed the same dependency. This is where oil crises stop being stories about geopolitics alone and become stories about system design. Once oil prices jump, the shock spreads through several channels at the same time. First come direct energy costs, fuel, heating, transport, electricity. Then come indirect costs. Goods cost more to move. Factories face more expensive production. Food prices climb because modern agriculture is energy intensive, from diesel to fertilizer to transport. Then comes the psychological layer. Consumers see prices they cannot ignore because fuel is one of the few costs that announces itself in giant numbers on street corners. Businesses become more cautious. Workers demand higher pay to offset higher living costs. Inflation expectations begin to shift, and once expectations move, policymakers have a much harder problem on their hands. Central banks may tighten policy to prevent inflation from spreading further, but tighter money can weaken growth and employment. IMF work suggests oil price shocks can generate persistent labor market losses in oil-importing countries, with especially strong effects in energy-intensive sectors. So the crisis never stays where it began. It migrates from supply into prices, from prices into wages and expectations, from expectations into policy, and from policy into employment and politics. That is why oil crises are so politically corrosive. They force governments into choices the public hates. Let inflation run, and households get squeezed while savings quietly lose value. Tighten policy, and growth slows while unemployment rises. Spend heavily to shield consumers, and fiscal pressures increase. Do too little, and legitimacy erodes. Oil-exporting states and firms with spare capacity may gain windfall revenues. Traders who move early can profit. Strategic producers gain leverage. But consumers, import-dependent economies, transport-heavy industries, and lower-income households pay first and pay hardest. Oil shocks have a very efficient business model. They privatize the gains and socialize the pain, and that pattern did not end with the 1970s. In 1990, Iraq's invasion of Kuwait removed large volumes of supply from the market and triggered another sharp oil spike. In 2008, oil prices surged to record highs in the months before the global financial crisis, helping tighten conditions for an already strained global economy. In 2022, Russia's full-scale invasion of Ukraine and the sanctions and dislocations that followed sent energy prices sharply higher, especially in Europe, reminding the world that energy dependence remains geopolitical, even in a supposedly sophisticated financial age. And in 2026, fresh Middle East disruptions again pushed governments and markets into familiar emergency thinking. In March, The IEA announced that member countries would make 400 million barrels available after conflict-related disruptions, while the EIA projected elevated near-term Brent prices tied to disruptions of the Strait of Hormuz and longer-term elevated prices linked to possible disruption through the Bab el-Mandeb Strait. History does not need the same cast to deliver the same lesson. It only needs the same structural weakness. What makes this even more revealing is that all of this is happening during an era obsessed with energy transition. We talk constantly about electrification, renewables, batteries, and the gradual decline of fossil dependence. Some of that transition is real, but oil still matters because the current system still runs through it in ways that are hard to replace quickly. Aviation depends on it. Shipping still depends heavily on it. Heavy transport depends on it. Petrochemicals remain deeply embedded in modern manufacturing. Food systems remain energy-intensive, even where electricity is gaining ground. The surrounding physical economy often remains tied to petroleum. Logistics, that is why oil disruptions still behave like system-level events, not niche commodity stories. The IEA's recent work on sheltering households and governments from oil shocks makes the point indirectly. Even now, oil volatility remains powerful enough to threaten household finances, inflation control, and public stability. And that brings us to the deeper lesson. Every oil crisis is a reminder that prosperity built on cheap energy is more conditional than it appears efficient. Systems often look stable precisely because their vulnerabilities are hidden during normal times. Supply chains feel elegant. Just-in-time logistics feel intelligent. Long-distance trade feels effortless. Central bankers and finance ministers start to believe they are managing a monetary machine, when in reality, part of what they are managing is a physical one. Then a shock arrives, and suddenly the abstraction collapses. The economy is not just made of balance sheets and policy rates. It is made of ships, pipelines, refineries, choke points, fuel tanks, harvesters, trucks, and chemistry. When the flow of a critical input is threatened, the financial system does not hover above the problem. It transmits it. That is the economic rule behind every oil crisis. Not that oil is uniquely dramatic. Not that geopolitics is always unpredictable, but that modern economies are far more sensitive to disruptions in foundational inputs than they like to admit. When energy scarcity hits a system built on abundance, everything downstream becomes more expensive, more political, and more fragile. The most expensive part of an oil crisis is not the barrel itself. It is the illusion that the system was less dependent than it really was. So the next time an oil shock arrives, dressed up as an emergency, remember what you're actually watching. You are watching a hidden dependency become visible. You are watching inflation rediscover its physical roots. You are watching policymakers relearn that markets do not erase strategic weakness. And you're watching the same structural pattern echo from 1973 to 1979, to 1990, to 2008, to 2022. And now into 2026, the trigger changes. The rule does not. If this gave you a new way to see the world, hit subscribe and turn on notifications. At Finverse Stories, we dig into the history that explains the headlines, so you always know what you're really looking at. History has the answers. We'll show you where to look.